just go through some of these examples. What's a certificate of deposit? It's a vehicle that you put your money in for a certain period of years, and if you take your money out before a certain amount of time has passed, there's a penalty. Okay? A CD is basically a bond. And remember what a bond is. It's an IOU. You give your money to someone. In return, they give you interest, and then at the end of that period of time, they give you your principal back, which is that initial amount of money you lent them plus that last interest payment. The difference is a CD is just sold by a bank. Okay? So if you're going to buy a house in 6 months, and you have the option of putting it into a savings, first of all, are you going to save that money or invest the money? Save, right? Short term, very low risk. You're not going to be aggressive with that money. Are you going to put it into a savings account yielding 1% or a 2-year CD earning 6%?
When do you want to buy it?
6 months. You're going to put it in the savings account. You can't tie up your money because you need it before then, and there's going to be a big penalty if you take it out before the 2-year period. But what if there's a 6-month CD that's yielding 5% for 4%, and you have a choice of a savings account at 1% or 4% 6-month CD? You put the money in the CD, and then 6 months from now you get your deposit back, the principal, as well as the final interest payment, and then you can buy your house. Okay? And if you buy it through a bank, it's secure. All right? Money market account. Is anyone familiar with that? Yes?
So you put your money in, you can take it out whenever you want.
You put your money in, you can take it out whenever you want. Yes?
Also, there's no penalties?
No penalties. That's exactly right. A lot of times you're going to get a slightly higher yield on a money market than you are in a savings account. Okay? And you want to look at that. The thing to consider with a money market is usually if you want to write checks off of it, it's a minimum of something like a $250 check. So if you don't want to necessarily use it as your checking account, but you can link a money market account to your checking account, keep a really low balance in your checking account because you're probably not earning anything on it, and have any extra money go into the money market where it's going to earn maybe 4 or 5%. Okay? I mean, I have clients who literally have $600,000 sitting in an account earning 1%. And they don't even realize it. You can move it over, make 5% in a money market. Literally. When you're showing $600,000, that's a big difference in a year. Okay? Now, I'm not saying that you have an extra $600,000 laying around, but even on small amounts, it will make a difference. Okay? And then corporate and government bonds we talked about. Right? Corporate bonds are going to be a little riskier because you're taking on a little bit more risk that the company may not necessarily be around. Okay? Then if you look on page 36 and 37, there's a whole list of growth types of investments. Okay? Now we've all heard of stocks. I know you guys know all about stocks and bonds. But what about the rest of you? I know you know that term, but does it mean anything to you? What does it mean when you buy a stock? Yes?
Buying partial ownership in whatever company that's.
You're buying ownership in a company. That's exactly right. Do any of you own some stock? Yes? Have you gotten it as gifts? Have you actually done some research and purchased it?
Well, I mean, last year I was in the stock market game, so I kind of did that on my own. But for the most part, my dad usually looks through the stocks
and buys stocks for you?
Yeah.
Okay. All right. So do you, for those of you who do own stock, do you follow how your stock is doing? You look online and see what the price of the stock is doing, and it's fun to kind of see if you're making money or losing money that day? Okay, good. So you can buy stocks in a lot of different ways. You can buy directly from the company in some cases. You can buy it online through something like Ameritrade or TD Ameritrade or E-Trade. You can buy it through a full commission broker.
We were just doing a project in business.
Right.
We were looking at whole life insurance and how agents usually want to push that because it was saying that in the first year they get 50% of your
Yes, premium.
premium as a commission.
Yes.
And some people just live off of selling whole life. And
Okay. I love that you brought this up because this is a big hot button for me. What she was talking about is they just did a project and they were learning about whole life insurance and how a lot of people really push whole life. The people who push whole life are the people who make a ton of money selling whole life. Okay? All of you at some point in your lives, you're going to be in college and you're going to have a college buddy who becomes a life insurance agent and is going to call you your first year out of school and say, you need to buy whole life insurance because if you don't, it's going to be the worst mistake you ever make. But what they're not telling you is that the commission they're going to make is 50 to 80% of the premium that you're paying. And I cannot tell you the horror stories I have seen, people coming in who met with a life insurance agent who sold them a whole life policy. There are certainly people who it makes sense, but who have paid a fortune in premiums because they're paying a huge commission to this guy to sell them the policy. So just be very wary about this. Hopefully, we're going to get to life insurance and we'll talk a bit more about that.
Also, the thing about that isn't more expensive because it's like investment
Yes.
combined with it, so you should like separate them.
Exactly. It's more expensive because not only are you buying the life insurance, but you're also buying a savings vehicle. And we're going to get to insurance and we'll talk about that a little bit more. But you definitely want to understand what you're getting into when you're buying whole life insurance. I'm glad you mentioned that. Okay, what are some other growth investments?
But in a mutual fund, you can get some companies might return like some stocks.
Okay, good. Did all of you hear that? Okay, I'll repeat it. Basically, good thing, okay, so a mutual fund allows a lot of investors to pool their money, and it's professionally managed by someone who supposedly knows what they're doing, right? Who knows how to invest your money. So one of the things that's great about it is if you have $500 to invest, you probably aren't going to be able to be very well diversified. And what do I mean by that? Well, own a lot of different types of companies, maybe some stocks, some bonds. You only have $500, but if everyone in this room had $500 and it could all go into a pot, we've got a lot more money to invest, right? So that you can be better diversified. And what she had mentioned was that's helpful because if you buy one stock, the company goes under, you're going to lose your $500. But if your $500 is invested in 10 different companies, one of the companies goes under, it's not going to have nearly as a significant impact on that $500 that it would if you were invested in one company's stock, right? What else? What other types of investments are there? Yes? Real estate. Right. So all of you probably live in a home or an apartment and that's real estate. Your parents own some real estate. It happens to also be the place where they live, but you can buy a mall, farms, land, it's all real estate that you hope appreciates over time. You hope you buy it for $100,000 and it goes up to $200,000, and then the difference of $100,000 is, does anyone know the term for that, what that's called?
Spread. That's super stock in different.
From a tax perspective? If I pay $100,000 for something and I sell it for $200,000, what's that? I should say, if I pay $100,000 and I sell it for $150,000, what's the $50,000? Well, the $150,000 is your gross proceeds. The difference is called a capital gain. Okay? So if I buy a piece of property for $100,000 and I sell it for $150,000, that $50,000 capital gain, taxed. Exactly. So you don't get the $50,000. You got to pay a piece of it to the IRS, and you've got to pay a piece of it to the state of New Jersey if it's in the state of New Jersey. Okay? So you always have to remember the tax consequences associated with this stuff. Let's just talk briefly again about mutual funds. When you're investing in a mutual fund, okay, and all of you will at some point, if you invest in a 401k plan, you're going to have access to mutual funds to put that money in. Okay? Something that I want you all to really pay attention to, this is another really important item that I want you to remember. We've only had, 20 so far? Really important things you have to remember from today. Fees and expenses. When you put your money in a mutual fund, you are paying for someone to manage that money for you. Okay? And there can be a really, really, really big difference in how much you're spending to have your money managed at different mutual fund companies. So you could put your money, let's say you put $10,000 into a mutual fund and you're going to pay 1%, so you pay $100 a year to have that money managed. If you pay 2%, you're paying $200 a year for that money to be managed. Okay? Or you could pay 0.2% and pay $20 a year. And obviously, you have control over which mutual funds you put your money in. So you want to make sure that you keep your costs as low as possible. Okay? The other thing I want you to be aware of is the difference between no-load and load mutual funds. Okay? What does it mean when you buy a loaded mutual fund? Has anyone ever heard that term? If you buy a mutual fund with a load, this was part of your project, you don't remember? It's a sales charge, okay? So if you're buying a mutual fund through a commission broker, you're going to pay, usually it's about 5 or 6% up front. Okay? But there are no-load mutual funds where you don't have to pay a sales charge. Okay, and